You stood at an airport currency counter before an international trip and traded $800 into local currency. The number on the board looked reasonable. You did not pull out your phone to check what the actual interbank rate was. You did not ask why the rate on the board was different from the rate on your banking app. You took the cash, counted the bills, walked away, and assumed the difference was a normal conversion fee. You lost approximately $60 on that transaction, not in disclosed fees. In the gap between the real market rate and the rate the counter gave you, $60 on $800 is over 7% gone before you reached your gate. That gap has a name. You will understand exactly what it is by the end of this video. 74% of retail Forex traders lose money. That is not a statistic from a trading forum. Brokers operating in the European Union are legally required to publish it in their advertisements. It appears in small text next to the account sign up button on every major platform. 74 out of every 100 people who open a Forex account and attempt to trade currencies for income end the year with less money than they started with. That is not a skill problem. That is a structure problem. This video fixes that. Here's what I need you to hold before we go further. There is one number that separates the small fraction of retail Forex traders who survive long term from the majority who do not. It is not win rate. It is not prediction accuracy. Most retail traders never calculate it. We will get to exactly what that number is. By the end of this, you will understand what the Forex market actually is, why the leverage brokers advertise as an opportunity, functions as the primary cause of retail account losses, and what the traders who do make consistent money from this market actually do that the losing majority does not. Here's what Forex is. Forex, short for foreign exchange, is the global decentralized market where national currencies are bought and sold against each other. It operates 24 hours a day, 5 days a week, running continuously across 4 major financial centers. Sydney opens first, Tokyo follows. London opens as Tokyo is closing. New York opens while London hits its midday session. The market never fully stops during the trading week. This matters because no single exchange controls Forex pricing. Unlike stocks, which trade on centralized exchanges with a single official price per second, Forex prices are quoted simultaneously by a global network of banks, brokers, and market makers. The price you see on one platform may differ slightly from the price on another platform at the exact same moment. Every Forex trade involves a currency pair. You are never buying one currency in isolation. You are always simultaneously buying one currency and selling another. Your USD, the most traded currency pair in the world, tells you how many US dollars 1 euro is currently worth. If your USD is at 1.08, 1 euro buys $1.08. Here's the example. You buy your USD at 1.08. 3 days later, the pair is at 1.10. You sell. You made 2 cents per euro on your position. On a standard lot, which is 100,000 units of the base currency, that 2-cent movement is $2,000 in profit. But here's the part most beginner explanations skip entirely. You did not profit because euros went up. You profited because the dollar weakened relative to the euro. The euro could be losing value against the British pound, the Japanese yen, and the Swiss franc simultaneously. And you would still profit on this trade if the dollar lost value faster than the euro did. The euro did not need to be strong. It only needed to be stronger than the dollar. The key point is this: Forex is not about finding a strong currency. It is about finding a currency that is stronger than the one you are simultaneously selling. Relative, not absolute. That framing changes what analysis looks like. Retail traders approach currency pairs the same way they approach stocks. Strong economy equals strong currency. That logic fails constantly when central bank policy diverges from the underlying economic data. But knowing how pairs work does not prepare you for what brokers build into the product itself. Here is what leverage is. Leverage lets you control a currency position worth far more money than you actually deposited by borrowing the remainder from your broker automatically the moment you open the trade. This matters because Forex brokers routinely offer leverage ratios of 50 to 1, 100 to 1, and in some unregulated markets, 500 to 1. Here's what those ratios mean when the market moves. You open an account with $1,000. Your broker offers 100 to 1 leverage. You open a position on your USD. You are now controlling $100,000 of currency exposure with $1,000 of your own capital. A 1% adverse move in the exchange rate does not cost you 1% of your $1,000. It costs you 1% of $100,000. That is $1,000. Your entire account is gone on a 1% price movement. 1%. Your USD moves 1% within a single trading hour on a quiet news day. This is not a rare event. This is baseline volatility for a major currency pair. At 500 to 1 leverage, a 0.2% adverse move consumes the account entirely. 0.2%. That is the difference between a morning quote and an afternoon quote, with no economic news in between. When your available margin is consumed, your broker closes your position automatically. This is called a margin call. You do not get to wait for price to recover. You carry the entire downside. The key point is this: leverage does not change the probability that your analysis is correct. It only changes the cost of being wrong. Traders who blow their first Forex account describe the same sequence. The trade was directionally right. Price went against them first, hit their stop, then moved exactly where they expected it to go. The leverage turned a temporary adverse move into a permanent capital loss before the actual direction played out. But leverage is not the only cost built into this market. There is something that hits every single trade before price moves at all. Here is what the spread is. The spread is the difference between the price at which your broker will sell you a currency pair and the price at which your broker will simultaneously buy it back from you. This matters because the spread means every single trade you place starts at a loss before price has moved 1 point in any direction. You pay the spread on entry and pay it again on exit, on every trade, on every platform. Here is the example. URUSD is quoted with a buy price of 1.0800 and a sell price of 1.0797. You buy the pair at 1.0800, you immediately close the trade. The broker buys it back from you at 1.0797. You are down 3 pips on a trade you just opened. The market did not move. Nothing changed in the underlying economy. You lost money the instant you entered. A pip is the 4th decimal place on most currency pairs. On URUSD, 1 pip equals $10 on a standard lot. 3 pips is $30 on every single trade, on entry and on exit. Now, run the math forward across a full year of active trading. A trader placing 10 trades per day at 3 pips of spread per trade is paying $300 per day in transaction costs alone. Over 200 trading days, that is $60,000 extracted from the account before a single losing position is even counted. A trader with a $20,000 account is paying 3 times their total capital annually just to access the market at retail spread levels. Most retail traders never calculate this number, not once. This is the airport counter. You accepted the rate on the board because checking felt like unnecessary friction. You walked away over 7% below the real market rate. Retail Forex traders do the exact same thing across hundreds of trades, never totaling what the spread extracts, and then attribute their consistent net losses to bad analysis or bad timing. The analysis is often fine. The structural cost of every entry is the problem. The key point is this: spread is not a footnote in Forex. For most retail accounts, it is the largest structural cost in the entire operation, larger than the losses from directional mistakes. But there is still another reason retail accounts fail that has nothing to do with transaction costs. Here is what actually drives Forex prices. The Forex market processes $6.6 trillion in volume every single day. The New York Stock Exchange on a high volume day processes roughly 20 to 25 billion. Forex is not a bigger stock market. It is an entirely different category of global financial infrastructure. This matters because of who accounts for that volume. Retail traders, meaning individual people trading personal accounts, represent approximately 5% of daily Forex volume. The remaining 95% is institutional. Central banks managing national currency reserves. Commercial banks executing client orders and proprietary positions. Hedge funds running currency strategies that take weeks to fully express. Multinational corporations converting international revenue back to their home currency. These institutions do not use moving averages or momentum indicators. One of the most important strategies they run is called a carry trade. A carry trade works like this. You borrow money in a currency with a very low interest rate, convert it into a currency paying a high interest rate, and collect the difference over time. For years, institutional traders borrowed in Japanese yen at near 0% interest and bought Australian dollars paying 4 to 5% annually. The interest rate differential between the two currencies was the return. Hundreds of billions of dollars in carry trade positions ran simultaneously, pushing the yen lower and the Australian dollar higher for extended periods that had nothing to do with either country's economic performance relative to the other. When global volatility spikes and carry traders unwind at the same time, currency pairs can move 3 to 5% in a single session with no economic data released. The move is not driven by news. It is driven by $1 trillion in the same direction reversing at once. Here is what this means for retail traders. The Federal Reserve holds a rate announcement. Analysts expected rates to hold steady. Rates hold, the dollar spikes immediately on the announcement, moving 0.2% higher in 30 seconds. You had positioned short based on dollar weakness. Your stop triggers, the dollar then reverses over the following 2 hours and drops nearly 1% below where it opened. Your analysis was right. Your direction was correct. You were stopped out in the first 30 seconds before the actual move played out. The key point is this: retail traders are not competing against other retail traders in the Forex market. They are competing against institutions with tighter spreads, faster execution, superior positioning data, and in the case of carry trades, flows that move major pairs for structural reasons disconnected from anything visible on a retail chart. But some retail traders do survive this market. The ones who do operate from a completely different framework. Here's what the traders who consistently profit from Forex actually do. They stop trying to predict where price will go and start identifying where price has already proved it responds. This matters because historical price structure is the one form of market information available equally to retail accounts and institutional accounts. It is in the chart. It is the record of where price reversed, where it found support or resistance repeatedly, and where those reactions held across multiple time periods. Here is the example. EUR/USD has reversed upward at the 1.05 price level 4 separate times over the past 2 years. Each time the pair touched that level, buyers stepped in and price moved higher within 48 to 72 hours. A structured trader does not need to know why that level matters. They wait for price to return to 1.05, look for evidence that buyers are responding again, enter long with a stop at 1.0460, and target 1.08. Risk on the trade is 40 pips. Reward is 300 pips. That is 7.5 to 1 reward to risk ratio on a single position. The trader does not need to be right often to make this work. If they take 6 trades at that level over 3 months, lose 5 of them at 40 pips each, and win one at 300 pips, they end the quarter 100 pips positive before spread cost, profitable on less than a 20% win rate. The key point is this. That number I told you about at the start, the one that separates the traders who survive from the ones who do not, is the ratio between what you collect on winning trades and what you surrender on losing trades. Not win rate, the ratio. In Forex, you can be wrong more than half the time and still be profitable. You cannot be right most of the time and still survive if your losses are larger than your wins. Most retail traders invert this completely. They exit winning trades quickly because they are afraid of giving back gains. They hold losing trades because they are convinced the market is about to reverse. Combined with high leverage and the constant spread extraction on every entry and exit, this behavioral pattern is what actually produces the 74% loss rate. Not bad analysis. Wrong math on exits applied consistently over hundreds of trades. Here is what you now know. 1. Forex is the simultaneous buying of one currency and selling of another. Every position is a ratio between 2 economies, 2 central banks, and 2 sets of economic conditions. Analysis that works for a single asset does not translate directly to currency pair analysis without accounting for both sides of the pair. 2. Leverage amplifies both gains and losses by the same multiple. At 100 to 1, a 1% adverse move ends the account. 1% is below average volatility for a major pair on a normal trading day. The leverage ratios brokers advertise as standard are the ratios that produce most of the margin calls that close most retail accounts. 3. The spread is the mechanism built into every single trade that takes money before price moves 1 point. It is the airport counter running on every entry and exit. Most retail traders never calculate what they pay in spread across a full year. The total is almost always larger than their net losses from directional mistakes combined. 4. Retail traders are 5% of market volume. The other 95% is institutional flow, including carry trades that move major currency pairs for structural reasons that have no relationship to what a retail technical chart shows. 5. Consistently profitable retail Forex traders trade price structure with strict reward to risk ratios. They do not need a high win rate. They need the wins to be large enough relative to the losses that the math remains positive after spread costs are removed. 6. The spread, the leverage, and the behavioral tendency to hold losses and cut wins early are not 3 separate problems. They are the same structural problem repeating at 3 different levels simultaneously. Fix one without the other 2, and the losses continue. Before you open a funded Forex account, run a demo account for 30 days and calculate 3 numbers at the end of the month. Your average winning trade size in pips, your average losing trade size in pips, your estimated total spread cost based on trade frequency and average spread. If the average loss is larger than the average win, the strategy does not survive real capital, regardless of how often it is directionally correct. If the spread cost alone exceeds your net profit from the period, your edge does not exist at that trading frequency. Fix the math before the money goes in.